On a Tuesday morning, Sarah got a call. The listing broker said the seller preferred conventional financing. A young couple across town was told their only option was a subprime lender. The internet chipped in, "You can't buy a home with a subprime loan." That line circulates like fact, but it isn't a universal rule. There are real moments when subprime loans exist, real consequences when people take them, and real choices worth knowing. This video pulls the curtain on what people mean by impossible and shows how to evaluate the offers you'll actually see. First, what do people mean by subprime? In short, it's lending to borrowers with higher credit risk. Lenders price that risk into interest rates, fees, and terms. The label covers many realities: higher APRs, adjustable structures, smaller down payment requirements, or extra fees. Saying you can't buy a home confuses a myth with a market preference. Some sellers, loan officers, or real estate platforms do prefer prime financing. But subprime products exist because markets serve demand for buyers who can't qualify for prime or need speed or flexibility. When do subprime loans appear? 3 conditions: credit profiles that don't meet conventional underwriting, market stress that tightens credit and prices, and niche needs like quick closings or rehab projects. After financial shocks, mainstream lenders tighten standards and subprime channels either disappear or become more expensive. In active seller markets, sellers may insist on conventional financing, making subprime deals harder, but in others, like fixer-upper purchases or private sales, subprime lenders can still close transactions. It's the context that matters, not a blanket impossibility. Let's be concrete about the costs. Subprime loans usually mean higher interest rates and more lender fees. Origination charges, points, higher closing costs. Some include rate buydowns that are temporary, or adjustable rates with low introductory teaser payments. Those teaser rates can be tempting, but the long-term APR and total finance charges are what matter. You need to translate offers into cash flow, monthly payment today, payment after any reset, and the total dollars paid over a reasonable horizon, not just the headline rate. Risks pile up beyond higher cost. Adjustable rates can reset upward. Some loans have negative amortization or balloon payments that demand refinancing or sell-off. Prepayment penalties can trap borrowers into long-term high costs if market rates drop. And there's the human risk: job loss or medical emergency that turns an already expensive mortgage into a crisis. Those risks turned systemic in 2007 to 2008, and they still inform checklists that lenders and counselors use today. So how do you evaluate a subprime offer? Start with this simple translation. Convert every term into monthly cash flow and a worst-case scenario payment. Ask for the loan estimate and run 3 numbers: starting payment, payment at first reset, and payment if rates rise by 300 basis points. Ask about caps, index, margin, and whether the loan allows negative amortization or has a balloon. Those are technical phrases, but they explain whether the loan is a short-term bridge or a long-term obligation. Credit score thresholds matter. Many lenders categorize subprime roughly as credit below about 620, with higher tiers below that. But credit score is only one axis. Debt-to-income ratio, employment history, down payment size, and property type all change what lenders will offer. A 600 score with a 30% down payment looks different from a 600 score with no reserves and an unstable job. Underwriting is a mosaic, not a single number. Fees hide in plain sight. Points buy rate, but sometimes the seller pays points, or a lender offers a no-point option with a higher rate. There are underwriting fees, broker fees, document preparation costs, and sometimes insurance add-ons. Those add to the effective interest rate. Always ask for the total closing costs and then calculate the break even if you're planning to refinance. If it takes 5 years to recoup the extra fees, that's a meaningful number when you expect to move or refinance sooner. Let's look at real outcomes, not names, but patterns. In one pattern, borrowers accepted an ARM with a low introductory rate to buy a house quickly. Markets slowed, jobs tightened, and resets pushed payments above what they could afford. They either sold under distress or faced foreclosure. In the better pattern, buyers used short-term expensive financing to close, then improved credit, increased income, and refinanced into a fixed rate. The difference often came down to planning, cash reserves, and luck. How common are these outcomes today? Lenders tightened rules after the crash, and regulators added safeguards. Many high-risk loan products that once proliferated are rarer, and underwriting checks income and reserves more rigorously. That doesn't mean subprime vanished. It means the spectrum of risk changed. Private lenders, portfolio lenders, and specialized mortgage brokers still originate higher-risk loans, but usually with more disclosure and often with partner investors who expect to manage the loans differently. If you're shopping and see a subprime offer, here's a practical checklist. Get the loan estimate early. Compare APRs, not just rates. Calculate payments after resets. Confirm prepayment penalties. Verify caps and whether a balloon exists. Ask for underwriting guidelines in writing. And check whether the lender holds the loan or sells it. A lender who keeps the loan on their books tends to underwrite more conservatively than one who bundles and sells it off. Running the numbers is a skill you can do with a simple spreadsheet. Column 1, months. Column 2, payment today. Column 3, payment at reset. Column 4, cumulative interest. Add a column for worst-case scenario, where rates add 3 percentage points. See how quickly your principal erodes, or grows, and whether you still have emergency funds. If the worst case pushes your housing ratio above 50%, that's a red flag for many financial counselors. Avoiding subprime loans starts earlier than the paperwork. Improve your credit profile. Address collections, reduce credit utilization, and fix errors on your report. Save for a bigger down payment. A 10 to 20% down payment opens doors to conventional or FHA loans with better pricing. Shop early, pre-approval timelines, and multiple lender quotes change leverage. And consider alternative programs. FHA, VA, USDA, community loan programs, and local down payment assistance can convert a desperate situation into a conventional path. If you do face a subprime offer and can't wait, negotiate. Ask the lender to reduce or remove origination points, demand a clear explanation of fees, and request rate caps or a fixed-rate alternative. Sometimes sellers will accept a lower offer in return for taking a loan that's not conventional, but that requires transparency. Get any side agreements in writing, and shop at least 3 lenders. Rates and fees vary widely, especially in the middle market where underwriting standards aren't uniform. There are situations where a subprime loan is a rational choice. If you need a short-term bridge loan to close quickly on a property you plan to renovate and flip in months, a higher rate might be acceptable. Or if a job change guarantees higher future income and you're certain a refinance is imminently possible, a temporary rate premium can be a tool. Those are conditional strategies. They require contingency plans, liquidity, and honest stress testing of the what-if scenarios. When does a subprime loan become impossible in practice? When sellers refuse non-conforming financing, when market competition demands clean, conventional pre-approval, or when underwriting thresholds for a specific property type, think condos or co-ops, exclude higher-risk products. In hot markets, cash or conventional buyers win offers. So a subprime loan isn't impossible because the loan can't exist. It's impossible because market dynamics and sale conditions make it non-viable for winning competitive bids. That leads to strategy. If you have a subprime profile but want to win a bid, consider these layered moves. Partner with a cosigner or bring a non-contingent higher earnest money deposit. Negotiate seller concessions to cover rate buydowns. Focus on properties where underwriting is more flexible, like single-family modest homes versus high-rise condos. Or find sellers who prefer a quick close, where a portfolio lender can compete. Each move trades one risk for another. Read every concession carefully. Refinancing is often the path out of a subprime loan. But refinancing requires improvement, better credit, stable income, and sometimes equity in the property. That means planning the exit before you sign. What's your timeline to refinance? What metrics must improve? Credit score, debt reduction, or property value? If you can't articulate those milestones, the loan could become a long-term burden rather than a temporary tool. Community resources matter. HUD-approved housing counselors, nonprofit credit advisors, and local housing agencies can review loan estimates and point out predatory terms. They're especially useful when an offer includes unusual clauses like prepayment penalties or balloon payments. Getting a second pair of expert eyes can save thousands because they know the red flags that aren't obvious to first-time buyers or rushed clients. But beware of predatory packaging. In some cases, brokers bundle expensive products, credit insurance, unnecessary closing services, or markups on appraisal fees. Ask for itemized receipts and question any third-party fees you didn't request. If a lender pushes add-ons aggressively, walk away. A legitimate lender explains alternatives, provides clear documentation, and answers why for every fee on the estimate. Let's return to outcomes with 2 anonymized case studies. Case A, a buyer took an ARM with low initial rates, no reserves, and paid considerably more after resets. They sold under pressure 2 years later at a loss. Case B, a buyer accepted a higher-cost portfolio loan to close on a renovation property, used savings to complete rehab quickly, and refinanced to a fixed conventional mortgage 6 months later. The difference: cash reserves, realistic timelines, and an exit strategy. Decision rules are helpful. If you lack emergency reserves equal to 3 to 6 months of mortgage and living costs, avoid adjustable rate high payment risk. If your plan depends on property appreciation you can't control, don't base affordability on that alone. If the loan has a balloon or negative amortization, require a clear refinance path with lender preconditions. These aren't moral judgments. They're tests for fragility under stress. For buyers who decide to avoid subprime entirely, practical alternatives exist. Strengthen credit with targeted repairs, negotiate seller concessions, stretch your timeline to save a larger down payment, or pursue government-backed loans that allow lower credit scores with set underwriting protections. Also consider lease-to-own arrangements or seller financing as a bridge, but scrutinize those contracts the same way you would a loan estimate. If a lender pressures you with "this is your only chance" language, it's a red flag. Any trustworthy lender will allow you time to shop, provide clear documents, and explain trade-offs. High-pressure tactics historically correlate with poor outcomes. Take the time to compare at least 3 offers. Even in fast markets, there is usually room to verify the numbers and get counsel. Regulation and transparency have improved, but responsibility still rests with the borrower. Read the loan estimate and closing disclosure line by line. Ask for the annual percentage rate and also the projected total interest paid over 5 and 30 years. Understand whether mortgage insurance is single premium or paid monthly. Those details determine whether a subprime route is a temporary tool or a long-term trap. Where does this leave the central myth? Buying a home with a subprime loan is impossible. It's false as a universal claim and partially true as a practical warning. The loan can exist. The problem is the marketplace and the personal finances around the loan. Understanding the terms, stress-testing payments, and planning an exit change a risky product into a manageable one, or reveal it as too dangerous. The nuance matters. Final checklist before signing. 1. Get the loan estimate and calculate worst-case payments. 2. Confirm caps, margin, index, and balloon terms. 3. Verify closing costs and points and who pays them. 4. Ensure you have reserves to survive a rate shock. 5. Have a written refinance or exit timeline. If any of those items are missing or the lender refuses to answer, walk away. A few last practical tips. Get pre-approved, not just pre-qualified. Shop online but call and talk to loan officers. Tone and transparency matter. Use a HUD counselor for a second opinion. If you're using a mortgage broker, ask whether they'll show you lender-run quotes and who gets paid what. Keep copies of every document and don't sign anything with blank spaces or missing numbers. The bottom line: subprime loans are neither a moral failing nor a universal impossibility. They're a set of products with costs and risks. With information, discipline, and a clear exit plan, they can be used responsibly in narrowly defined situations. Without those things, they can be catastrophic. Your job as a buyer is to turn an emotional decision into a documented plan before money changes hands. There will always be lenders willing to make expensive loans. There will always be buyers with urgent needs. The trick is to know the price and the fallback. If you walk into closing with full knowledge of monthly cash flow, reset scenarios, fees, and an exit plan, or with a trusted counselor who has checked those boxes, you change a gamble into a reasoned financial decision. That's the real difference between myth and informed choice. If you're in the process now, pause. Get the loan estimate, run the 3-scenario spreadsheet, call a HUD counselor, and compare multiple lenders. If you're planning, focus on credit repair, savings, and programs that expand affordable options. Buying a home is a major decision. It's worth the extra time to convert an intimidating subprime label into concrete data you can act on. We ended where we started. That blanket phrase, "it's impossible," hides nuance. The loan can exist. The market and your plan determine whether it should. Treat every offer like a contract with potential consequences, not just a rate to accept in the moment. If you want, download a template spreadsheet to run the 3 scenarios before you sign and talk to a counselor. A clear head and clear numbers will get you farther than a viral aphorism. Thanks for watching. If this helped, consider sharing it with someone about to sign mortgage papers. There's one small request. Read the closing documents before you sign them. If you want more, I made a short guide to reading the loan estimate. Link in the description. Spend an hour now. It could save years of worry later.